This is probably the most popular topic that I do. Of the six that I do, I think this is the most popular. And of course, it's everybody wants to know how to find money. Um, so that's our topic for today. And I'm going to try to give you some practical advice and talk about some of the options. Um, Very quickly, Diane already mentioned it a little bit, so I will be very brief with it. My background. Um, I have been a small business owner for the past 28 years, I guess it is now. But before that, like many small business owners, I started in corporate world. I spent 25 years in the corporate world. Um, I started now, like I say, 27, 28 years ago, I started in the franchise world. I used to own two Huntington Learning Centers. I owned those for 23 years. Um, and learned what a great opportunity small business ownership was for most people, and therefore became an advocate for helping people get into it safely. And for me, that means franchising. Doesn't mean franchising for everybody. So for 12 years, including some overlap, I'm not that old. I'm old, but I'm not that old. So a lot of those franchise consulting years were um, while I on the learning centers. So why do you want to listen to me today? Because to make all that happen, I had to fund my own businesses and expanded and did a lot of funding over the years in my own franchise businesses. And now for these past 12, it's over 13 years now, I help my clients find funding. So it's it's a big part of what I do all the time. So I'm going to hopefully be able to share some practical information for you. As we do this, please keep in mind, a lot of times people will ask me, what's the best? What's the best franchise? What's the best bank? What's the best loan? What's the best way to get funded? There is no answer to that. All funding is personal. Your circumstances, your financial condition, your business, the nature of your business, all of that is going to drive different funding options. So there is no right answer. The right answer is what's going to work best for you and your business. I always like to warn people, I'm not an accountant. I'm not a financial advisor. I'm not a lender. So what you're going to get from me is practical experience about how things work, from a borrower's point of view. Um, but as I said to the question earlier, it's always great to get advice. So consult with accountants, consult with financial advisors, talk to more than one lender. Very important that you work with other people. Um, very Something that I talk to my clients about very loudly. I think is really important to understand. I think accountants and financial advisors would universally agree with me, and that is when you're funding your business, use as little of your cash as you possibly can. Um, get money from other people. That's what banks are for. That's what lenders are for. You protect your cash. It takes a long time to accumulate cash. And once you spend it, it's going to take a long time to replace it. And if you don't have cash, banks won't lend you money. So it's unfortunately true that if you don't have money, it's hard to get money. Um, and you never know when there's an emergency popping up, whether it's in your business or in your personal life. And a bank's not going to help you out when you don't have cash and you're in an emergency. So protecting your cash is really, really important. Um, there are a lot of different ways that people finance their businesses. I'm going to try to give you the most popular ones. It's not to say that there aren't others, some outliers, different kinds of things you could do than what I'm going to share with you. Um, but I'll go through some of the most popular ones. And as I make that transition, I'm going to stop every now and again to remind you that I love questions. There's no way I can possibly anticipate everything that you want to know, and the it's going to benefit everybody if you ask your questions. So put them in the Q&A, put them in the chat wherever they're supposed to go, and we'll take breaks and answer them. So Diana, let me know if there's a question. So speaking about popular options, the most popular option what most people who start a business will do is get an SBA loan. Um, the first confusion that comes up is the Small Business Administration does not lend money. Um, so don't go to the SBA looking for a loan. You go to banks for loans, and there are other SBA lenders. Um, what the SBA's role is to guarantee a percentage of the principal on your loan to the bank, not to you. So if God forbid your business should fail, the SBA is not guaranteeing your loan. They're not going to pay your loan off for you. They will guarantee it to the bank. So after the bank chases you to the gates of hell to get their money back, if they can't get it all back, they can go to the SBA and get some of that money back. The purpose of all of that is the government trying to encourage small business ownership and helping small business owners get started. Um, uh, Sorry, I'm doing this in reverse. um, Conventional loans are another option, but I will tell you that conventional loans, which have less paperwork, the terms tend to be a little bit kinder to the borrower. Almost never will you find a conventional loan um, for starting up a business, for expanding your business, for adding another location. For purchasing equipment to help you grow. Conventional loans are there for that, but to get off the ground, almost never. So if you go to a bank, you're almost always going to be looking for an SBA loan. Um, this is certainly for business startups and franchise opportunities. This is the most common thing that people do. There is a loan maximum on SBA loans. The SBA loans cannot exceed $5 million, which I hope will cover everybody's needs, everybody on this call. And that said, while there is that very high cap, what the program is really designed to do, and I wish more banks would keep this in mind, because some banks won't do.
Could someone let me know in the Q&A if Richard froze on your
Mm,
end? Hi, Richard. I think you froze for a minute. You did on my end here.
okay,
Yes,
uh,
yes.
I did. Where
About the
did I?
just about the last 15 or 20 seconds. Thank you.
Okay,
Thanks,
all right.
everyone.
So I guess it's probably the program's design line is the last one you heard. Anyway, we'll start. We'll
Yes.
go back to that one. So the purpose, even though there is a cap for very large loans, what the SBA is really trying to do, what their real mission is, just to get small businesses going. So they're trying to focus on getting loans of 150 and lower. Um, It does require to get an SBA loan, you do need to be credit worthy. So you're going to need a pretty good credit score. That and these terms, will you get the loan or not get the loan, is to a very large extent up to the bank. Most banks, I would tell you, are going to be looking for a credit score of 650. I would say is about as low as you're going to find a bank to go. What I usually see is 675 and above. Um, and your credit score is going to be one of the factors that's going to determine your credit, the interest rate, and we'll talk about that in a minute. The other big issue, and I think it trumps everything. I think it trumps collateral. I think it trumps your credit score. I think it trumps everything. Is post-closing liquidity. After you spend all the money you need to spend to get the business started, how much cash do you have access to? And this again comes back to that issue of protecting your cash. The bank wants to see that after you have paid for everything to get the bank to get yourself started, that you still have enough cash on hand to keep the business going if it doesn't go as quickly as you think it will, and to keep a roof over your head. So post-closing liquidity is probably the single biggest issue, at least in my experience. Uh, Even if you incorporate, which usually people incorporate because they want to protect themselves from liability in case somebody sues you, that type of thing, um, and frankly, in case you go bankrupt. Um, SBA loans do require a personal guarantee. So you're not going to escape obligations for the loan. Um, Historically, banks and the SBA have looked for 20 to 30% down. So in other words, if it's a $100,000 project, you're going to need to put 20 to 30,000 of your own cash in. So you do have to put in some cash. Slightly better news if you buy somebody else's business or if you buy a franchise. Usually, banks see that as a safer investment, and they will let you go with maybe like 10 or 20% down. That's typically what I see with my clients. Yes, Dane.
Thank you. Post-closing liquidity, what percentage of the loan are they looking for?
Well, what you need in terms of cash is that 20 to 30% down. The post-closing liquidity, it's going to depend a lot on the nature of the business. It depends on how quickly you think you're going to the cash flow will ramp up. So there's no one answer to that question. The faster your business ramps up, the less liquidity your cash on hand you're going to need, working capital. Um, my advice to you would be, and I think again, financial advisors and accountants would agree, you let's use franchise companies, right? Franchisors want you to have 3 months of operating capital on hand. So whatever it costs to turn the lights on and keep everything running, um, the franchisors look for 3 months. I usually recommend 6 months. Really conservative people would recommend a year. So if it costs $10,000 a month to pay your rent, to pay your employees, to pay your insurance, to pay your utilities, to pay everything that you need to pay, regardless of whether any money comes into the building, um, at least 3 months. I would say 6, and if you can get more, that's fine. It doesn't have to be cash. It could be a line of credit, but it needs to be someplace where you can raise that much cash short term if you need it. I hope I answered your question. If I didn't, ask again. Um, you may need to provide collateral. Loans above 150,000, almost always you will need to provide collateral. In other words, something that the bank can take. If again, God forbid, you should fail, the bank can take some asset of yours and easily liquidate that to get their money back. Almost always that's your house. Could be a stock portfolio, but it needs to be something that the bank knows that they can liquidate quickly. Yes, Dan. I'm loving this group with questions.
I know he does love questions. All that cash should be in a bank account specific to the business, correct? So it's
Correct.
good to move cash over at the start to show down deposit and liquidity.
Correct. And really, there's two buckets you need to fill. One bucket is for the business. One bucket is for your personal life. The bank wants to know that, yeah, you can keep the business going if no cash comes in. They also want to know that you can feed yourself and how you're going to do that. Now, in that instance, it could very well be that you can count on a spouse's income. You can demonstrate that your spouse's income, your partner's income, can pay the mortgage and keep food on the table. If that's the case, your spouse is also going to have to sign the personal guarantee. Spouses don't have to sign personal guarantees if you're not counting on their income to keep you going. But if you are, they're going to need to sign a personal guarantee as well.
Okay, thank you. We have two questions on the 401ks. Can that be counted as collateral?
Yes, let's come back to it.
He'll cover that for you. Can you get an SBA loan where it's not tied to your personal assets?
That personal guarantee is access to your personal assets. So your house, your stock portfolio, anything that the bank can grab a hold of and liquidate to get their money back, they're going to take it. I'm making that sound a little harsher than it is. Banks don't want your house. They don't want your car. Um, they're going to do everything that they can to not do that to you. At the end of the day, they got to get their money back. The SBA won't give them anything back unless they can demonstrate that they have done everything that they could to get it from you. Then the SBA guarantee will come in. But they're gonna work hard to not take your house. They're not in the real estate business. They don't want houses. I hope
Okay.
that answered your question.
What about an LLC to help protect your personal assets?
Doesn't matter. You incorporate, and you absolutely should incorporate. If somebody slips on the ice out in front of your building and breaks their hip, they're going to sue you. You don't want them being able to attach your personal assets. Banks will not be in that situation. The bank is going to say, "We don't care if your business fails, if your corporation closes. We're going to chase you personally."
Okay, thank you. What percent of assets over the deposit are they looking for? The full loan amount?
Again, it's going to depend a lot on your individual situation. It's certainly going to need to be a large portion of it. This is not exactly answering your question, but just to demonstrate, if you use your house as collateral or your stock portfolio as collateral, and you have $100,000 of equity in your house or your stock portfolio, they're not going to say that that's $100,000 worth of collateral because they have to allow for market fluctuations. So if the housing market crashes, they want to know that your house is still going to be worth enough to cover um, your loan. So typically in a house, they're only going to give you 80% of the equity as value towards collateral. Um, Again, a lot of these are individual circumstances. First thing I said was this: all borrowing is personal. Banks are going to look at the nature of your business. You know, if you're buying somebody else's very profitable business, that's going to be a different circumstance than if you're starting from scratch all on your own. And if you're buying a franchise, that's going to be another scenario. So it does vary a little bit. Um, but I would generally say go into it assuming that you need to come up with 100% of collateral. So you borrow 100,000, they need to know how they're going to get $100,000 back. And if it gets better than that, great. But assume you're going to need to provide collateral for everything. I think I said it, but in case I didn't, if your loan is under 150,000, very often, again, the banks can choose to not to do this differently, but very often, if your total loan is under 150,000, you may not need collateral. All right. Um, you're going to need a business plan. We'll talk about business plans later on. Um, Bank is going to require a written business plan. Don't just do it for the bank, do it for yourself. We'll come back to that. They're also going to need to see a resume. Now, if you're going to buy somebody else's business or a franchise, um, the bank may be a little bit more lenient about your industry knowledge. If you're going to start a business from scratch on your own, you're going to have to demonstrate to the bank that you have the skills, the background, the education, the knowledge required to start and run that business. So that's why they're going to want to see your resume. Buying somebody else's business, buying a franchise, often that they won't care about it at all because you've got other ways of learning how to run the business. Um, and there are different SBA loans for different kinds of things. There's different SBA loan for buying real estate than there is for buying for doing construction. And there are some businesses that aren't eligible for SBA loans. Um, I believe it's true that liquor stores, for example, can't get an SBA loan. Anything that's morally questionable is going to be hard to get an SBA loan for. So, background, let's talk a little bit about, excuse me, talk a little bit about some practical stuff. And this today and for the past year or so, this has really been a big issue that people need to understand. What is the interest rate? Interest rates right now are pretty high. Um, so the way it works is, as you can see here on the chart, the SBA sets a maximum interest rate that the bank can charge based on the size of the loan. The bigger the loan, the lower the maximum rate that they can put on top of prime. So let's use a specific example. Currently, as of a week ago, the prime rate was 7.5%. If you took a $200,000 loan from the SBA using the chart that I provided here, the bank can charge you a maximum interest rate on top of prime of 6%, so that the bank could charge you up to 13.5%. Now, most banks are not going to charge you that. If your credit score is 650 and they have some doubts about your business, but they still want to give you the loan, you're probably going to be looking at that 13%. If they see less risk, if you've got more collateral, if you've got lots of liquidity, well, then that rate may come down. Right now, most of my clients are seeing a little under 9%. um, so still pretty high. Still a reason to maybe look for other options, but that's how the interest rate is calculated. Because the interest rates are so high, even at the lower end of what the banks are really charging, people are looking for other kind of things. So let's talk about some other options. Unless if anybody's Diane, is there a question? Is something in there?
Yes, Richard. SBA loans do not resell alcohol, but they give loans out to bars. Why would that happen with bars but not liquor stores?
I don't know. I'm proud to tell you when I don't know, and I don't know.
I
I didn't know that they would do an SBA loan for a bar. Um, doesn't make any sense to me, especially because frankly, bars are very risky investments.
Okay, thank you. Are nonprofits eligible for SBA loans, especially for real estate purposes?
Yes,
For bank loans, when first payment is due, are you only paying interest or principal and interest?
depends on the bank.
Thank you.
Often banks will let you go interest only. Sometimes banks will let you go with no payment while interest is accumulating. At some point in this discussion, I'm going to recommend that you shop around. Don't just go to the bank that you currently work with and find out what the SBA loan is and take those terms. Shop loans, because different banks have different appetites for different kinds of loans. Um, uh, Offline, if you want to know what I think is the best, is the easiest bank to work with, I'll tell you offline. Call me. Call me.
Consulting business, what are the chances of an SBA loan? And let me tell you, I will be sending you, Rich, the presentation, so you'll be getting Richard's contact information for you to follow up.
Um, so I don't want to. A, I don't want to discourage people, and B, I don't want to. I don't want to paint with such a broad brush that I make it sound like what I'm saying applies in all cases. Doesn't. A startup business is very hard to get funding for. Something that you're starting on your own. It's very hard to get a bank to give you even an SBA loan. A consulting business where and I think I understand the question is that if I'm starting a consulting business, can I get an SBA loan? The answer to that question is yes, because you're probably not going to need much money. Um, at least if you're, in my terms, wise, If you're going to start a consulting business, you're going to start from home. So you're not going to have construction costs for modifying an office space. You can use the desk that you already have at home. You can use your computer that you already have at home. So your startup costs are going to be lower, and a bank is very likely going to, at least some banks. Now there are some banks that won't do an SBA loan for under $500,000. That is totally contradictory to what the SBA is supposed to be for. But some banks, a bank that I work with regularly, will do loans for any amount, any small amount. So if you've got a small amount and you're credit worthy and the bank thinks that, yes, you know a lot about that industry, so you could become a consultant, probably going to be okay. If you go looking for $500,000 to start up a manufacturing company, and the bank doesn't see that you have any experience in manufacturing, you're not going to get that loan. Startup businesses are hard to get funding for.
Okay, thank you. For loans, when is the first payment normally due? Not during construction, correct? As there is no cash flow at that time.
It's going to depend on the bank. And that's why you want to shop around. Some will say, yeah, you got to, the day that we give you the money, you got to start paying us. I would say that's the starting position. Then you begin negotiating and trying to find terms that are more suitable to you. But a loan is a loan. They want their money back, and they want it back according to the terms that you agreed to. So in theory, everybody has to pay the end of the first month. In practice, you could probably negotiate that.
Thank you. Can you unpack the SBA loan / real estate connection, home flipping, contracting, investing, and landlord business?
Don't know.
Thank you. Can you use loan disbursement funds to pay interest? I think the answer is no, but I wanted to ask.
Well, you mean use the money that the loan money to pay the interest?
Yes.
I think the bank would. I think the bank won't know if you're doing it. B, I don't think the bank would want you to do it. And C, I think it's a bad idea. Um, Paying salaries, even that, some banks some banks will let you pay a salary for yourself out of the funds dispersed. Some won't. I don't think they're going to be happy about you using the loan, the borrowed amount for interest. Again, how are they going to know? Unless they audit you, they're not going to know. But I wouldn't think they're going to like that. You better ask, because you violate the terms of a loan, they can call the loan in. Another one, Diane?
Yes, there is. So you will need personal capital to help pay interest until cash flow starts coming in, correct?
There's your working capital.
All right, thank you. Would you recommend credit union loans over commercial loans?
Sure.
And I
I
know we
wouldn't
have a
recommend them
couple
over,
of
but I would recommend that if you now a lot of credit unions don't do business banking and won't do business loans. More and more, I'm seeing. When I started 13 years ago, I have a lot of contacts at APG Federal Credit Union. They didn't do business lending 13 years ago. Now they do. So some do and some don't, but there's certainly no reason not to talk to them about it. All right. So SBA interest rates kind of high. There's no prepayment penalty. So if you took a loan now and your business takes off and you can get the loan paid off, get rid of that 9% interest, that'd be great. The interest rates also are variable, so we're already seeing loans dropping. But all of this high interest rate causes people to look for other things. So let's talk about some other options. And somebody was already asking about this. So you can use retirement funds. And I'm going to give you three ways you can use retirement funds. Really? Is that a good idea? Well, I can tell you it's a bad idea. What would be a bad idea, in my view, would be to take a distribution from your 401k, from an IRA, take the money out in cash. Because if you take that money out, just cash it out of your account, you're going to lose at, I would say, at least 30%. You're going to lose 10% for an early withdrawal fee. You're going to lose plus or minus 30% for federal and state income taxes. So if you take $200,000 out, you're going to lose um, uh, $80,000 in interest and taxes. I'm sorry, in penalty and taxes. That just doesn't make any sense. I mean, that's the $80,000 is a lot of interest on a $200,000 loan. So that's not what I'm suggesting. Somebody had already had asked a question about this option. It has the unfortunate acronym in the IRS world of ROBS, Rollover for Business Startup. If you talk to your accountant, if you talk to your financial advisor, most of them, even though people have been using this for about 40 years, and I would say the majority of franchise businesses are done this way, at least in part. A lot of financial advisors and accountants don't know about this. This is a perfectly legal option. It's in the IRS code. Um, and essentially, what it's doing is it's allowing you to buy stock in your own company so that you're not getting the money, your company is getting the money. Um, and you can then use that money for anything that you want, or anything, I should say, that your company wants to do with it, including use it for your cash infusion, including using it for a salary for yourself for a while. Um, so this is an option that a lot of people initially you say, "Well, wait a minute, I don't want to put my retirement money at risk." Okay, well, let's put your house at risk. That's better. I mean, if you take a loan, you're putting something at risk. If you invest in a business, you're putting something at risk. When you buy stock in General Motors and we have a pandemic or a great recession and General Motors gets into a lot of trouble, you lose a lot of your money. So you're always putting investment money at risk. The question is, what are the best terms? So this is an option that some people want to think a little bit more about. Yes, Diane.
This is a thought-provoking question. Given the obstacles of starting a business, is it worth it? What can new business owners understand and remind themselves to persevere and motivate themselves to start and continue operating a business?
Hey, that is a thought-provoking question, and I love it. And I hope you come back. I don't know when we're running this, but there is a webinar I do for Diane on planning for a business startup, and another one that I do on how to minimize risk. Um, is it worth it? I spent 25 years in the corporate world. I've spent 28 years owning my own business. It is absolutely worth it. Was it always easy? Absolutely not. Were there times that I was financially stressed? Absolutely, I was. I never failed, but I know a lot of people who did. I know a lot of those, I would say the majority of the people who failed brushed themselves off and did it again. If you want control of your own life, if you want the full rewards from your efforts, um, if you want to build a legacy for your family, there are so many reasons to have your own business. I do what I do because I believe that small business ownership is the right thing. I've done both, and I know that this is better if you've got the courage to do it. It's not as hard as it may seem. You just need to be smart. You need to do your due diligence. You need to understand not only what the business does, but more importantly, you need to understand what the owner does, and you need to make sure that you're going to enjoy. You're going to get up every day and enjoy what the owner does. Um, so, to me, the answer is absolutely yes. It's worth the risk. It's worth the risk potentially financially. It's worth the risk. and certainly lifestyle and satisfaction. It's to me, there's no question that it's better if you're the right person. I, Diane, I hope that answered you. And if you want to jump in on top, go ahead.
I just wanted to say too, and talk to us, the SBDC, talk to your SBDC consultant. He or she can certainly advise you if maybe a different approach or something that might be bothering you. It might be something simple that can be addressed, but talk to him or her about that as well, because that's why we're here. Um, can a 1031 real estate exchange work if you sell real estate to help with business startup funds and capital?
Okay, now you need to do this webinar for me because the questioner needs to do it because apparently you know stuff that I don't know. I don't know the answer to that. I love this group. It almost never happens. They ask questions I don't know the answer to, but this one, they're stumping me. This is stump the chump. I'm sorry, I
Uh,
don't know an answer to that.
that's okay. And but keep these questions coming. Okay. I'm finding that it is almost impossible to get startup funding. Had a lender recommend card stacking and HELOC. What's your thoughts? I'm currently self.
HELOC. Let's come back to HELOC. Um, I I'm going to go. It's hard, as I said before. If you're going to try to start up a business on your own from scratch, based on your own knowledge and experience, um, honestly, banks don't like that, and they don't. It's not easy to get a loan under those circumstances. Um, uh, some of the other options that we're going to talk about, this option right here that we're talking about, could be a good one for you. Um, the other option is, and I don't want this is going to sound self-serving, and I don't mean it to, but look at franchise ownership. You can pretty much anything, any industry you want to get into, pretty much everything is in the franchise world. Banks love funding franchises. Alternative, safest way to buy a business, buy somebody else's business. Find somebody who is selling a business because they want to retire for whatever reason, and find and do the financial auditing to make sure that it's a profitable business. Banks will fund, again, if you're creditworthy, they'll fund the acquisition of somebody else's profitable business. They'll do that all day long. Starting from scratch, banks are not in the gambling business, and that's how they see. According to the SBA, 50% of small businesses fail within 5 years, and the rate is higher for from scratch startups. So, hopefully, some of the other options that we're going to talk about this morning will give you some ways to raise funds.
Okay. And is there anything special to do if your retirement is in TSP from federal employment?
Um, you can still do this. Let me walk through how it works. There's only one qualifier that might get in your way, but let me walk you through how this works. So, what happens with a ROBS? Um, First thing you need to know is that your accountant can't do this. You can't do this on your own. An SBDC counselor can't help you with it. You need, just like if you have a 401k with your company, the company doesn't manage it, there's a plan administrator. You need a plan administrator to properly establish and manage your plan. The way it works is that that plan administrator will first create a a C corporation, because to do this you have to have a C corp. It can't be an LLC filing as a C corp. It can't be an S corp. It needs to be a C corp. That's what the IRS says. Go ahead, ask me why. I don't know. It's what the IRS says. It's what we got to do. The plan administrator will then develop a plan for you and your employees. Beautiful thing about this, in these days when it's sometimes hard to find certain classifications of employees, hard to find people to fill jobs, The more attractive of an employer you are, the easier it's going to be to find people. If you offer a 401k, very few small businesses do. So now you're offering a benefit that hardly anybody in small business does. Um, so they'll set up a plan for you and your employees. They will then help you work with your previous employer or your whoever is handling your investments to roll over 401k money, IRA money, TSP money, 403b money, any kind of pre-tax plan that you have put money in. This does not affect, it does not apply to Roth, and it does not apply to monies that is held with your current employer. It has to be either in an IRA or a 401k that's with a previous employer. You can't, and this has nothing to do with this plan. It has to do with the fact that your current employer won't let you do a rollover from their plan. So, yes, Dan.
Where do you find a plan administrator, or should you go through the current administrator of the plan that you have?
No, not from your current administrator. I work with three different companies that do this, and there are a lot of other companies out there that do it. I would be more than had three that I work with. I know are reliable, good terms, have experience. Again, my contact information is going to be provided at the end. Feel free to reach out to me, and I'll give you some names. Um, So they will, and by the way, the thing that can slow down the rollover, a bank loan can take a long time. An SBA loan can take a long time to actually have funds dispersed. This can be done in 2 or 3 weeks, as long as your plan administrator moves the money that fast. As soon as your plan administrator moves the money goes into your 401k and then into your corporation. So they'll assist you in rolling over the money into your new 401k plan, and then they will transfer the money from the 401k plan into your company bank account, not your bank account. You can't touch this money personally, otherwise you're going to pay taxes and penalties. So it goes into the plan. The plan essentially buys stock in your company. Now that money is in your bank account, and you can do anything that you want with it. You can also, if you had $200,000, you put $100,000 in your company, and the plan administrator can do the other 100,000 in Fidelity funds or 3M or whatever you want to invest in, just like your current employer, and would also manage that for your employees. So, simplest explanation I can give you, that's how it works. It's just like getting a new job and doing a rollover in a new job and telling the new plan administrator what you want to invest in. In this case, you're telling them to invest in your business. So, some of the benefits of doing it this way. Um, I mentioned that you need a cash injection. A lot of times people will do 50-50 or some other split, and they'll do an SBA loan for part of it and a rollover for the other part. And then you can use that as your cash injection, that 10 or 20% that you needed to put in. You are investing your retirement funds without any taxes or penalties in a business that at least has the potential to give you a better return. Just think about it in this. I mean, if we don't want to, even if we don't want to talk about how much money your company is going to make and how much more profitable it's going to be than investing in the stock market. If you're making 4% in your 401k, which I'm sure there are times you're making more, but probably on average you're making less. But let's suppose you're doing that. And your option is to take a 9% SBA loan. Why give up those 5 points? So it's a great way to use your investment money. Um, uh, Other issues that I want to talk about. You can use this for salary during the startup period. So you can say to the bank, "I've got here's my liquidity. I've taken my 401k money and I put it in the bank, and here's my liquidity. And I'm also going to pay myself a salary, so I will have salary during the startup business period when the business isn't making money. I'm paying myself a salary. Is this the same as using your cash, which I've cautioned you against? I don't think so, because this isn't cash. Cash implies liquidity. Cash implies that you can spend it. You can't spend your 401k. You can invest it, but you can't spend it. So it's not really cash. Um, uh, it's money that you invest. Invest it. Invest it in your business and save yourself debt service. If I sound like I'm trying to sell it, I realize I'm being a little enthusiastic about this. It's not for everybody. Not everybody should do it. Not everybody can do it. But it is an option that can help a lot. Yes, Dan.
How does your business pay back the stockholders or give a return?
If so, you have a couple of options. You can buy the stock back over time, so you can take the money back out and buy the stock back from the company. So essentially, you would just it's a paper transaction. It's not a real transaction. Um, but there is you don't have to pay anything back. There's no loan here. There's no debt service. Your employees probably more detail than we want to get into today. Your employees can theoretically buy stock in your company, which is something you may not want them to do. Um, I can tell you that with the three companies that I work with, including one that really invented the industry, they have never seen a situation where employees have actually bought stock in the company that they work for. And the reason for that is the category of shares. They are not there's not voting. They're B class shares. They're not voting shares, and they just don't have a whole lot of attraction to your employees. So the companies that I work with, they report back to me that they've never seen any employees buy stock. Theoretically, they could. So your employees are not going to be buying. It's going to be just like they would experience with any other employer. They can tell the plant administrator to buy GM today and 3M tomorrow. Um, so that's no issue at all. And they can take distributions and pay the taxes on them. And the plan administrator is going to manage all of that for you. It's just exactly the same way it works uh, with your current employer. It for you it would and your employees it would look exactly the same. All right. So I said there were three uses with SBA. I'm sorry, with rollovers, and I've already alluded to this one, um, and that is to do a rollover and an SBA loan. Now it's going to be a whole lot easier to get a bank to fund your startup business that I said before you couldn't get money for. If you say to the bank, "Look, I need $200,000 to start this business. I'm going to put 100,000 of my own in, and I need 100,000 from you." I'm making up the numbers could be any split. Now all of a sudden the bank is saying, "Well, wait a minute. If you're willing to take that kind of risk, and we know that there's that kind of security in the business, well, we would do that." So it makes it easier to get an SBA loan, even if all you're doing is using it for your cash injection, and if you're only using it for your liquidity, it's putting you in a much uh, better position to go to a bank and look for funding. Um, so that is another option. Don't use it all. Don't do the whole investment from your rollover. Do it in part SBA and part rollover. Yes, Diane. I'm loving
What's
this
the
group. We're going to need more time, Diane.
I know, that's okay. You're fine. What is the downside to making your business a corporation rather than an LLC?
I honestly, I can't think of any downside. I can tell you there's a lot of downsides to not doing it. You're putting, except for the bank and maybe a landlord, you're putting all of your personal assets at risk if you don't incorporate. Um, I mean, you've got to set up the corporation. You can do that yourself. You can go online and find guidance to how you can incorporate all on your own, so you don't have to pay an attorney. I would suggest you pay an attorney. I'd suggest you talk to an accountant and an attorney about what kind of corporation you want to be, because that's an important tax consideration. So, I mean, there's a little bit of an upfront complication where you need to be involved uh, with some experts to get the corporation set up properly. You are going to have reporting that you don't need to do. So it's a little bit more complicated, but it's buying you a lot of safety. So to me, it doesn't make any sense to not incorporate. Yes, Dan.
And that's in regard to a C corporation rather than an LC?
Oh, now that's a different thing. Again, this is something that you are going to want to talk to your accountant and about, because there is a difference in the tax treatment. One is taxed as a pass through. In other words, the money goes directly to you, and it's paid at as part of your personal taxes. The other is in a C corp, you're taxed as a corporation. What are the implications of that? Talk to your accountant. Um, uh, Again, the companies that set this up wouldn't force you to be a C corp. Doesn't matter to them. It's just part of the IRS code. So you have to be a C corp. Um, and not everybody wants to be a C corp. So there is that balancing act, and you want to talk to your accountant about it.
So you have to make it a C corporation to use your retirement, but will cost you more in taxes than an LLC, correct?
It might. That doesn't always cost you more in taxes. It costs you. The taxes are handled differently, not necessarily higher, different. All right, good. So that's the second way to use an SBA, and then the third way is to do a participant loan. As you probably know, you can go to your current employer and you can borrow money from your own 401k. You get your money out, so there's less money. You've got less money invested, um, but that money is given to you. You are going to have, it's a loan, so you have to pay it back, and you have to pay interest. But you're paying the interest back to yourself. You're paying the principal back to yourself. So the money's going right back into your account. So a lot of times people will slow down their regular contribution, and instead of doing a contribution, they do um, a loan payment. Small downside on this is that you're going to have a maximum of 50,000. A lot of people do startups, particularly scratch startups, and they can do it for less than 50,000. And that can't be more than 50% of the vested amount in your account. You need to talk to your employer about how that works, or your plan administrator, if it's not with a current employer. But you can do a participant loan, and that is very often used as that cash injection for bigger projects. But if you know, go back to the person who asked the question about getting an SBA loan for a consulting business. I don't know what your situation is, but if you could start up your consulting business for less than 50,000, you know, the interest rate here is going to be very, very low. It's going back to your account. You don't need to go bother with a bank. This is a perfectly good way to fund a business like that. So think about that as well. All right. So retirement funds may sound scary, but if you really think these options through, they make a lot of sense for some people in some circumstances. There is also the option of doing a stock portfolio loan. Essentially, you're taking those non-qualified funds, the funds that aren't retirement money, and you're using it as as collateral for a loan. As I already alluded to earlier, you're not, if your stock portfolio is $100,000, the bank isn't going to give you credit for that. They're going to give you somewhere between 60 and 80% of the value to use as collateral. Um, the investment stays in your name, the appreciation, the dividends, all of that stays in your portfolio. So you're not using any of your money. You're just using instead of your house, you're using your stock portfolio um, as collateral. Um, Again, another way to raise cash for the SBA injection. The only caution I would give you about this is that if you are an active trader, if you're somebody who is, watching the market, buying and selling on a regular basis, this option can have an impact on the flexibility of your trading because in most cases, the bank is going to have to approve any trades that you make. Understand, if you've got, all great stocks, very safe and reliable things today, and they value your stock portfolio for collateral purposes, and then you go out and buy junk bonds, um, they the the collateral value of that portfolio has just dropped. So they are going to get involved in your trading possibly. So keep in mind that if you're an active trader, that may interfere. But there's a source of collateral for you. Other funding options, and somebody asked about this: high interest rates, 9% plus or minus. Um, so, and we may have to use our home as collateral. So why not use the home's equity for our own purposes? We could do a second mortgage, get a lump sum amount, and very possibly a fixed term, a fixed rate, um, and raise our money that way at a lower interest rate. Or we could do a HELOC, variable rates. You don't need to take, so this a HELOC is a great way to demonstrate your liquidity because you don't have to take the money out. You don't have to be paying interest and debt service on it until you actually take it out, but it's there. So when the bank says, well, what if you don't make money this month? You say, well, I've got the HELOC to fall back on. What if you can't pay your mortgages? I've got the HELOC to fall back on. So a HELOC is another good option. Again, lower rates. I don't want to quote rates, but I think you're probably looking at either side of 6% for a HELOC right now, and compare that to the 9%. And if you can't get an SBA loan for your startup business, you're starting something from scratch, you can use your HELOC, or you could do a complete refi on your first mortgage. Um, Only caution on this one is if the bank wants to use your house as equity, as collateral for the loan, you can't hit it again. They're not going to let you do that. So it has to be a situation where you're not necessarily using your home equity as collateral. But this is, again, thinking about in terms of debt service and interest rates, this is a very good option in these days of high rates. So those are some borrowing options. There are economic development loans available as well. They are almost always distributed in Maryland at the county level, usually state funds. The most common one that I see people talk about is a video lottery terminal money. So it's money from the casinos that it goes back to the states and has been earmarked for economic development, and is given out to the counties to use as economic development loans. They tend to take more risk, so this is an easier way to get money for your startup from scratch. Um, they generally have lower interest rates. They do have a cap. I believe I haven't done one of these for a while. I believe the cap in most counties is 250,000. Um, but it is an alternative to a bank loan, and one where they're willing to take on more risk than a bank would. These are also often targeted to underserved group, women and minorities. but not always. It's not to say that although they may be prioritizing women and minorities, doesn't mean to say that men can't apply for the loans and get them. Sometimes they're targeted by geography and or industry. So those VLT funds, usually people refer to as the Volt Fund. So Volt funds, ideally they're trying to be within 15 miles of a casino, but it doesn't have to be. It's again, it's just a preference. As I already said, often it's going to be a lower than market rate on interest. As I already said, there is a restriction on the size of the loan, and the other issue is that every year the counties are given a bucket of money that they can disperse. Once that bucket is used up, then they stop giving out loans. The other thing that happens, though, to keep that bucket full is that the state gives them more money every year, and the loan proceeds from previous borrowers goes back into their bucket. So every year their bucket's getting bigger because the money that as loans get paid off, that money goes back to the county. But sometimes, often, they run out of money. Your SBDC counselor, by the way, would know about this in the local county, and they can put you in touch with the people who handle these kinds of loans. So another great use of your SBDC mentor counselor. Grants. I get questions about grants all the time. There are no grants. That's the simplest way I can say it. You may hear rumors of people getting grants. There are grants. So now I'm contradicting myself. There are some grants that are given out, but they're usually given out to existing businesses. So, for example, the county may have some workforce development money that they give out in grants to existing businesses to help them with employee training. A downtown area may have a revitalization program going on, so they give grants to businesses who will upgrade their facade. So you will see some grants for those. Those are usually small amounts. They are usually not enough money to get a business started, and they're not usually for business startups. So talk to SBDC mentors. If one was out there, they would know about it. But I would tell you that that's probably not going to happen. Sorry. I usually get questions about that, and Diane sometimes jumps in.
There are no questions right now, but the only thing I would add to that is there is through the Division of Rehabilitation Services, if you or someone you know gets supplemental income, there is a grant that they're willing to give you $15,000 up front. However, with that being said, if you choose to take advantage of that opportunity, your benefits cease. You will no longer get those. So that's something we don't recommend. That's something to really, really think long and hard on. But that's the only thing I have to add on that. And there are no questions on that right now.
Okay, good. All right. So the other thing that people talk about a lot is partnerships. And partnerships are, a lot of my clients do it. I've seen it work very well. But sometimes people mean different things by different kinds of partnerships. So they can take a couple of different forms. I think what most people would normally think about is if I have a partner, it's an active business partner, somebody who I'm working with in my business. And we each have operational roles inside the business. Sometimes I have a passive partner, a partner who has invested money in my business, has ownership rights, however that ownership right may be expressed, but they are a part owner. They're a true partner. They're just not operationally involved in the business. They're passive. They're an investor only. Sometimes, and you see this a lot with family, where we have a passive partner who's not an owner, who doesn't have any interest in the business, but is a co-signer on the loan. Again, you see that sometimes with family situations where a family member will say, "Yeah, I'll sign the co-sign the loan for you to help you get the funding here." Makes it easier for a bank to do it. If you don't have collateral and your parents do, maybe you can get them to co-sign a loan for you. They're now a passive partner, and may behave like a partner. Um, Sometimes there's an informal gift, small amounts. Oh, you need a certain amount of money. I can help you. I'll just write you a check, and I'm not. I have no other obligation, but I'll give you money to help. So it's just a gift. It's kind of a partnership. And again, they may have an opinion about what you're doing with your business. And then finally, I don't know that people always think about these folks as partners, but they are angel investors and venture capital. Um, you can check me on this. Go on the internet and then ask the question: what percentage of businesses are started with angel investors or venture capital? And the number is going to be in single-digit percentages. Um, this is very unlikely to occur. I'm not saying it doesn't occur, but it is very unlikely, and it's hard to plan on starting your business for this. I certainly wouldn't go very far down the road in uh, building up your business, spending any of your money on your business until you had that money in your hand. Angel investors, venture capital sounds great, very, very infrequent. Yes, Dan.
Do you have any recommendations on how to seek partners?
Um, Networking. And networking is a whole topic in and of itself. Most the best way to grow a business these days, the best marketing strategy to grow a business is networking, at least in my experience. And that's, if you don't have people, you want to talk to family, you want to talk to friends, you want to talk to business owners who you may know. So all of that is what I would call networking. Um, in talking to these folks, they may know people who, I know a couple of people who are saying to me all the time, if you come across somebody who you think is a good risk, good business person, and they need money, I would consider investing in somebody. So networking is probably your best source. I don't think there's any. I don't think there's any platforms out there. The internet does everything. So maybe there's an internet platform that is for investors. I'd be a little leery of that. I think networking is your best source for finding partners.
For economic development loans, is there a similar credit worthiness requirement?
Not as tough. They're not going to lend money to anybody. They're not going to take an infinite amount of risk, but they're much less risk averse. Um, that's why they're there. At least for those particular loans, as I said, they are. They often target uh, groups that are underserved and starting businesses, people who have trouble finding money because they are more risky for a bank. So that's the purpose. Economic development loans have several purposes. One is economic development. The other is often to help underserved populations. Um, so yes, they do tend to take more risk and give lower rates, but they'll often have caps on how much they'll lend. All right, I'm loving these questions. There are some risks and obligations and considerations for partnerships that and again, I'm always feeling like I'm being a Debbie Downer in some of this stuff, but I think it's important to share with you some of the things that you need to be wary of. We talked about failure earlier. You don't want to fail. And sometimes things that you're not expecting can cause problems. So the first thing I would tell you is, particularly with active partners, be clear about roles, decision making, exit planning, and all of this needs to go into a formal, legally prepared operating agreement. I know is your best friend and you've known each other since you were 5 years old, and neither one of you would ever do anything bad to anybody, and you're always going to agree on everything. Yeah, no, this is business. Get a formal operating agreement. If I mean, it comes down to what you may think are silly things that would be easily resolved, but they are very often not. If one of you wants to expand and take on another loan so that you can, build a warehouse or buy more equipment, what happens if the other one, the partner, doesn't want to do that? What if you decide that, well, part of our conversation should be company cars, and the partner doesn't want to do that? There's all kinds of decisions that have to be made in small businesses. Do we hire this person or not? Do we fire this person or not? Um, there are a lot of decisions that have to be made, and you're not always going to agree. There needs to be an established process for how you're going to work together. Um, there are some legal issues in contracts and loans and leases and other legal agreements that you need to be aware of and understand. And I'm going to use the best example that I can think of. There is a phrase that you will see in all leases, in almost all contracts, in every franchise agreement that I've ever been party of. Um, but it's certainly true in loans. And the phrase is joint and severable. And it's a phrase that people pass over and don't really understand. What joint and severable means is that if God forbid, the business fails, the bank or any other creditor can chase whoever they want. So if one of you skips town and the other one is left behind, you don't pay half of the loan back, you pay all the loan back. And if you've got a lot of money and your partner doesn't have any money, the bank can choose to chase you for the debt. If you've got a house and your partner doesn't, they can take your house and not your partner's house. Um, so joint and severable means that the bank can chase you both, or the bank can chase one of you. The terms apply that way. So understand that going in. Um, that particularly applies to the partner who's bringing in the money. Um, you also have to have situations where you want to define buyout rights. So you or your partner decides that you want to retire, and you invested some money to start off with, but you now believe, probably true, that the business is worth a lot more. How do you decide how much? And what if the partner who's left behind doesn't have the money to buy you out? Um, so defining what happens under what circumstances you can leave and how the financial circumstances are going to be dealt with in the case that somebody wants to get out, or you want to push the other person out. How does that work? Um, uh, one of the other big questions is decision making. It's going to be, the company makes money. You and your partner will take a salary. Okay, that's fine. You got your salary, but now at the end of the year, we made some money. Do we keep the money in the business? Do we reinvest the money that the company made beyond our salaries, or do we take that as a distribution? How do you decide that? All of these things are really important to decide before you get into business with one another. Um, so what I would suggest that I'm going to come back to some of this with regard to these more passive folks. Um, be careful about passive partners who say, "Well, yeah, I'll co-sign the loan," and they're not going to be involved in the business except when they're worried about you being able to pay the loan back, and then they start feeling like they've got an interest in what you're doing. So be confident in the relationships and that, in fact, your passive partners are going to remain passive. With regard to gifts, sometimes people think that they can just write a check for any amount and not, I can just give you as much money as I want to. There are tax laws about that. So make sure that you understand what the amounts are that can be given before taxes come into effect. But bottom line on all of this, what I was trying to lead up to is, if you're going to have a partner, get a formal operating agreement that is drafted by an attorney, and have an attorney look at every contract, every formal agreement that you're going to sign as partners. Make sure that you've got an attorney involved in these things. It's great to have friends, it's great to have family, but this is business and you need to treat it that way. So again, I'm not discouraging you from partners, but it adds a level of complication. All right, summing up. Um, First thing I would say to you that there are a lot of options. I've covered the ones I think most people think about and deal with, but there are some other small options besides that. Um, Best solution, as I said in the beginning, it depends. 401k, the rollover option may be good for some people, but for a variety of reasons, whether it's taxes or uh, the amount that's in your account, or the fact that you're currently employed with in the current plan, a lot of things make that not possible. Startups, hard to get an SBA loan, so maybe that's not going to work for you. It's always what's best is different. Protect your cash. We talked about that enough. Accurately project your liquidity needs. The SBA, as I think I said earlier, the SBA tells us that 50% of small businesses fail within 5 years. They will go on to say that the main reason for that is poor capitalization. You run out of money before you become profitable. You believe that you knew how much you needed, and you were wrong, and you didn't have enough to get yourself through that startup period, whether it was personally or for the business. So projecting your liquidity, how much cash you need access to, and borrowing the right amount. Don't get too little, but don't take too much. You got to pay the debt service on the loans. So if you take more than you need, you're going to be paying debt on money that you don't really need to have. So take the time, again, taking time, doing proper planning, doing proper due diligence. Financial planning is a very big piece of that. Make sure that you know what your capital requirements are going to be. I talked about this already. Um, Different banks have different terms, different lenders have different terms. Shop. Don't just go with the bank that you're currently working with. Do the research, take the time, go look for options. Um, Talk to experts, talk to trusted lenders, talk to accountants, financial advisors. Not least, talk to your SBDC mentor. Um, the first two, well, the CPA, the financial advisor is going to cost you money. The SBDC mentors are going to give you great advice, and it's not going to cost you anything. So that was what I wanted to cover today. I greatly appreciate all of your questions. I'm sorry for the ones that I couldn't answer. I hope the ones I did answer were helpful. Hope the information was helpful. If you have questions on any topic that we talked about today, or if anything else you think I can help you with, this will be in the presentation, so you don't have to take a picture of it. I promise you that although my business is about franchising, I'm not going to try to convince you to buy a franchise. It's not what I'm about. If you want to know about it, I'll tell you, but that's not what I'm going to do. But if you think I can help you in any way, please reach out. That QR code there will give you access to some other webinars that I've run, and some other business startup information that may be helpful.